Hi guys, for the past few years, the trading space has been flooded by a lot of gurus teaching smart money concept or SMC. Now the best selling point for this concept is its high risk to reward ratio, meaning the risk is small, but the upside is really huge. Now while it looks good on paper, and I must admit it does give you that bragging rights when you did catch that 1 to 15, 1 to 20 RR, you have to realize that you are walking on a slippery slope. And there's a lot of hidden truth behind this that could prevent you from achieving that consistency that you are really after. So in this video, I will share with you 7 reasons why I think new or developing traders should not use this strategy as their starting point, because it will impede their trading journey. Hi guys, how you doing? So this video is the sequel of my other video, High Win Rate is Better Than High Risk to Reward. So for those of you that haven't watched that video, please do watch it. There's a lot of gems that are shared in that video. But it's okay, if you haven't watched that video, you don't have to watch it first before you watch this one. It doesn't really matter in which order you're watching it. Everything will make sense anyway, and I will re-explain if I'm making any reference to the other video. I will still explain again in this video. Okay, so just quick recap. With any trading strategy, there's no such thing as a high win rate and high risk to reward. So whenever you have a trading strategy, and if you push your win rate higher, you will tend to pull your risk to reward lower. If you push your risk to reward higher, you will tend to pull the win rate lower. So it's like a game of tug of war. There's going to be a tension between the two. Okay, so what is defined as high risk to reward? Okay, so anything above 1 to 3, meaning you're risking 1 to gain 3, anything above that is considered high risk to reward, right, in my opinion. So 1 to 4, 1 to 5, 1 to 6 onward. And typically it has a lower win rate. For some of you that have already watched the other video, you have seen these quadrants before. So what I did was I divided different trading strategies into 4 different categories, okay, 4 different quadrants in this case. So quadrant number 1 is any trading strategies that has a win rate of less than 50%, but it has a risk to reward of more than 1 to 1. Okay, so it's 1 to 2, 1 to 3, 1 to 4 onwards. Okay, quadrant number 2 is trading strategies that has a win rate of 51% or more, right, with a risk to reward of more than 1 to 1 again. Yeah, so it's 1 to 2, 1 to 3, 1 to 4 onwards. Quadrant number 3 is any trading strategies that has a win rate of less than 50% with a risk to reward of 1 to 1. Okay, so no more, no less. And quadrant 4 is any trading strategies that has a win rate of 51% or more and a risk to reward of 1 to 1. Again, no more, no less. Now, out of these 4 quadrants, there are 2 quadrants that we're not going to talk about. Okay, and they are quadrant 2 and quadrant 3. Why? With quadrant 2, let's say you have a trading strategy that falls under this quadrant. That means you already have an edge. This strategy has a win rate of more or equal to 51%. Okay, go and watch my other video, Trading Edge Introduction. So there I explain that anything 51% or more, right, that means you have an edge over the market. If you have anything less than 51%, that means you have no edge. So you already have an edge over the market. So it's 51% or more. Right, even if you're actually getting 1 to 1 from a strategy, over time you know that you'll be winning, right? You'll be making profit. But in this quadrant, it says it's trading strategies that has a risk to reward of more than 1 to 1. So meaning it's 1 to 2, 1 to 3, 1 to 4 onwards. So that means if you have a trading strategy that falls under this quadrant, you are already consistently profitable. So this is the ultimate goal. This is where everybody wants to be. Now, quadrant number 3 is any trading strategies that has a win rate of less than 50%, meaning you have no edge over the market. So it's only a matter of time until you put your account to the grave. You know over time you will lose money because your win rate is less than 50%, and whenever you win, you win 1, and whenever you lose 1. If you are in quadrant 3, I strongly recommend for you to go back to the drawing board, do more tests, do more experiments, make changes as required for you to actually get out of this quadrant 3. Because especially when you're actually on live account at the moment, you are actually walking on thin ice if that's the case. Okay, so quadrant number 4, right? I've already discussed this on the other video. High win rate is better than high risk to reward, because it means that the trading strategy has more or equal to 51%. That means you have an edge over the market. Even with the risk to reward of 1-to-1, over time, you'll be winning. So this is, for me, I think, is the safest starting point for new developing traders. But in this video, what we're going to talk about specifically is strategies in quadrant number 1. Okay, is a trading strategy that has a win rate of less than 50%, but offer a risk to reward of more than 1-to-1. Okay. Right now, what you have in front of you is a visualization of win rate and risk to reward, and in relation to comparison between trader A and trader B. Okay, so you have trader A here and trader B. Okay, and both of them are new or developing traders. And this spectrum over here is your win rate spectrum. Okay, so this is being on the lower end of the spectrum, 10% win rate. And this one is being the high end of the spectrum, 80% win rate. Okay, now I have again to assume that the lower win rate is offering higher risk to reward ratio. Okay, and then this one, the high win rate, is offering a lower risk to reward ratio. Again, just to refer back to what I spoke about, there's no point talking about low win rate and low risk to reward, because I mean, it's a losing game anyway. So we're not gonna even talk about it. Okay, and I explained to you about edge, right? Minimum you need to have 51% or more, otherwise you have no edge. And if you haven't watched my video trading edge introduction, please do. I've explained everything in details over there with examples as well. So this side, on the right hand side of this 51%, is the ones with edge, and anything to the left hand side of this 51%, so 51% or lower, means that you have no edge. Okay, and so let's just, for example, trader A is using trading strategy that offers a 54% win rate, okay, with a 1-to-1 risk to reward ratio. Okay, and let's say trader B has or is using trading strategy that has a 30% win rate with a 1-to-5 risk to reward ratio. I genuinely believe that trader A will have a much more positive and smoother learning curve than trader B. And I will share with you the 7 reasons why I think that will be the case. Okay, so a bit of a disclaimer. This context is for new or developing or unprofitable traders only. And this is not about cutting your trade shorter than your original analysis for the sake of win rate. Yeah, so what do I mean by this? It means that if you have an analysis and your analysis says that once price picks up your entry, so you are in a trade right now, you need to take profit at 40 points away from your entry point. Now, I'm not saying that you need to cut it short to 12 points away from your entry point, so then you can take your profit quicker, shorter, and then you can improve your win rate. No, I'm not saying that. I'm saying that, in fact, you need to stick to your original analysis. But, okay, and it's a big but, that 40 points away from your entry has to be backed up by data, proven test. That outcome of this test says that you have a higher probability and positive EV, expected value, if you take your TP, take profit, at 40 points away from your entry point. Yeah, so it has to be backed by data, and the data has to say that you have a high probability chance reaching that take profit level. Reason number 1 why using a high risk to reward and low win rate trading strategy is not the greatest starting point for new or developing traders. You are on the wrong side of probability most of the times. Okay, so no natural edge. So if your trading strategy didn't actually offer you a risk to reward of more than 1-to-1, you are already on the losing game, right? So you're already on the losing side. So you would experience more losses than wins in this case. And as a new or developing traders, in my opinion and in my assumption, if you are new and you're developing, that means this is something that you haven't done before. So it's a new skill or new profession that you just started to learn how to do it, right? So for me, just with anything, you would want to have a really, really good base, right? A good solid foundation of what is right? Not what is wrong. But if you start your trading journey using a low win rate and high risk to reward, your base or your foundation is actually based on something that's wrong more often than not, right? And for me, it's like, it's counterproductive. I think it needs to be based on something that's actually correct most of the time, so you can train your mind, train your eyes, train your understandings as well of the right way. Reason number 2, the right analysis does not equal to profit. Why? Because most of the time, this kind of style trading, high risk to reward and low win rate, it requires the traders to put a very, very minimal super tight stop loss. Okay, so it has no room for error whatsoever. So you could have the direction right, you could have the trade idea right, but price just gonna take you out by a point or two, yeah, before it actually go into your take profit and more. Or the entry precision most of the time has to be very, very precise, that it is quite common for you to have the right direction, you have the right trade idea, but price just didn't pick up your order because you just missed price by another point or two as well. Reason number 3, being induced to forego a natural edge. The best way to explain this is, imagine you're playing roulette, and let's say you want to bet on a single number, right? Number 10. If you bet $1 and after a spin the ball falls on number 10, the payout is 1 to 35, right? So if you bet $1, you'll get $35. If you bet $10, you will get $350. So the payout is huge. Risk to reward is 1 to 35. Okay, that is the upside. But if you take a step back and then just remove the high payout, do you wonder why? Ask yourself, why do you think the dealer would give such a amazing payout, right? 1 to 35. That is actually to entice players or you, okay, to be on the wrong side of probability. And not only on the wrong side, it's the extreme wrong end of probability. So if you were to bet on a single number, that means that your probability or your chance of winning is only 2.7%. And that is 1 divided by 37 because you have 18 blacks, 18 reds, and 1 0. 2.7%. That is extremely, extremely low. It is almost, I mean, okay, let's just imagine this in your day-to-day life. If someone were to tell you that you have a 2.7% chance of passing the exam, you wouldn't go home and think that, oh yeah, at least I still have a chance, right? I still have 2.7% chance of passing the exam. No, you would come home and think that, oh shoot, I've already blown that exam. I don't think I'm gonna pass that exam. 2.7% is really, really low. But people still consider to put some risk on a single number because of the payout. Now, I want you to process this as a perspective. Win rate is already predefined by its mathematical probability. Now, what do I mean by this? Imagine the even numbers on a dice. The probability of the even numbers on a dice will be 50%, right? So 3 out of 6 is already predefined. Even before you roll the dice, it's already been predefined. It's not like a what if, right? What if this happened? No, there's no what if. It's already predefined. The probability of a coin flip, right? Heads or tails. For heads, it's already predefined, it's 50%. For the tail, it's already predefined 50%. Roulette, for example, even though the players have no edge, right? As I explained to you in my video on trading edge introduction, let's say the probability of reds or blacks, it's already predefined even before the dealer spins the wheel. But the payout, the risk to reward, is a conditional thing. Unlike win rate, it's not predefined. Okay, even though the dealer says that, okay, I will pay you what, 1 to 35 if you bet on a single number and you happen to be right. That 1 to 35 is only a promise, right? It's only if you get it. So it's not predefined. Whereas the win rate, the probability of you getting blacks or the probability for you getting red is already mathematically predefined. And going back to trading, if you have a win rate of 70%, and let's say your risk to reward is 1 to 1, that 70% is already based on something, a collection of data, you've backtested it, and then you came to conclusion that you have a trading strategy that offers a 70% win rate. It has already happened. You don't have to hope or wish that you get that 70% win rate. It's actually based on something, based on historical data. Whereas the risk to reward, it is based on if you win, you get a 1 to 5. If you win, you get a 1 to 10, right? And this is why I want you to process this as a perspective, because risk to reward is not predefined, it's conditional. You only get it if, right? If you win. Whereas on the win rate side, it's already predefined mathematically. If you take one side of the coin, you know you will have 50% chance. If you take even numbers on a dice, you know you will have 50% as well. Yeah, so hopefully that gives you a perspective on win rate and risk to reward. Reason number 4, not the best environment to build your confidence, right? Because you will experience more losses than wins. So one day you would experience fear or sadness, and the next day you feel really happy and excited. The next day you feel anxious. The next day you feel frustrated. It's just like an emotional roller coaster. And as a new or developing trader, obviously this is actually not the best environment you want to be in. Yeah. Reason number 5, you condition yourself to being wrong most of the time. Okay, so it's not a big deal. I believe that trading is like a business. So in order for you to play your edge, you need to risk something, right? When you risk something, of course, there's going to be a probability for you to lose that risk, right? But that's why it's called risk. And just like with any business, it has an expense. There's no such thing as a business with no expense. So again, there's no such thing as a trading strategy with no losses. So yes, of course, you have to be able to handle your losses. Absolutely. If you have a high win rate and low risk to reward trading strategy, if you experience like losses more than usual, straight away it will trigger a red flag, right? Like, what is going on, right? Something's not right. Is the market changing, right? Have I not been following my rules? Or whereas with the low win rate and high risk to reward, because you condition yourself for being wrong most of the time, you felt that it is okay, right? So the lines between was it the system's fault, or your behavioral fault, or was it the market's change condition? Did things happen in your personal life that sort of affecting your trading performance? These things are all mixed up into one big smoke, right? Because you just kind of condition yourself to just being wrong most of the time, so you think that it's no big deal, it is okay. Now, reason number 6 is, for me, is the most lethal out of all. Slowly give you feedback when you have been off your game. Not just with anything. If you are at work, or if you are an athlete, you play sport, and if you are a trader, things could be happening in your personal life, issue with your physical health, issues with families, relatives, friends, and whatever. Things that are happening in your personal life may impact your performance, right? At work, or at or if you're an athlete, at sport, and also with your trading. Coming on the back of reason 5, because you've conditioned yourself for being wrong most of the time, it is slowly giving you the feedback. And by the time you find out that things need tweaking, things need changing, it is very likely that it's already too late, right? You are already in too deep. Whereas with the trading strategy that offers a high win rate and lower risk to reward, because you're so used to of expecting winning after winning most of the time, when things are not going as well, you know straight away, because you have that extreme comparison, if that makes sense. Yeah. Reason number 7 is often misused as an excuse to repeatedly making unnecessary mistakes, right? So I have this funny little character here. That you see the tattoo. Oops, sorry. You see the tattoo there. No regrets. Okay. Now with reason number 7, because high risk to reward trading strategy offers, again, a huge payout, right? High risk to reward. I'll give you an example. So say for example, you are a trader that use a high risk to reward but low win rate trading strategy. You feel and you see a setup, but outside of your trading hours, you don't normally trade around these hours. And then you thought, oh, okay, you know what? Every time I win, I would win 1 to 8, for example. So it's you risk 1 to gain 8. So 1 to 8, you thought, you know what? What's a money? Like, let's just see what happens. Let's just take this setup, even though it is outside of my trading hours. Let's just give it a go, because if I'm wrong, right? What's 1 against 8, right? So whenever I lose, it's a -1. If I win, I will have a +8. So you take it. And then let's say you see the setup and you have this criteria that you normally tick off, but it only ticks off half of the boxes, right? I'm saying to you that no, it's not a great setup, right? It's probably a C grade or B grade setup at best. And you thought, you know what, let's just take it anyway, because if I'm wrong, it's -1. If I'm right, I will get a +8, right? So let's just take it anyway. And let's say you see a setup that your friend used, right? You've never tested this setup before, but he claims that he makes money from this setup. You thought, you know what, I'm just going to give it a go. Why? Because even if he's wrong and I'm wrong, okay, you know, it's a -1, right? What's a -1 compared to a +8? So you see where I'm going with this. You just keep on having this excuse in your head to keep on taking unnecessary mistakes. Now, what you have here in front of you is consecutive losses matrix. I did not make this matrix. This information is available on the internet. There's other traders as well that have used this as a reference. So basically on the left-hand side here is a percentage of win rate of your system, of your strategy. So it's a 5% trading strategy with a 5% win rate, 10%, 15%, 20%, all the way to 95% win rate. These numbers across is 2 consecutive losses, 3 consecutive losses, 4 consecutive losses, all the way up to 11 consecutive losses. These are from 50 sample trades. Okay, look at this, the one in blue circle. Yeah, so trading strategy with a 60% win rate. Again, is nothing too optimistic. It's just nothing too crazy. It's just 60%. Okay, just slightly above that 51% mark. It has a 70.4% chance of 4 consecutive losses in a row, right? Now, I want you to use this as a comparison as this one, okay? Trading strategy that has a 30% win rate. You see 69.1%, so it's close to this one, right? But instead of 4 consecutive losses, it has 10 consecutive losses, right? Out of 50. Now, again, this is not 4 losses in 50 trades. And this is not 10 losses in 50 trades. This is saying that the chances of 10 losses in a row is 69%, which is really, really high, right? And this one is saying that there's a 70% chance of 4 consecutive losses for this kind of trading strategy, a 60% win rate. Now, as a new or developing traders, I don't think, you know, handling 10 consecutive losses in 50 sample trades is going to be easy, right? I think it's going to be difficult. Even for me, it is very difficult. I can't normalize this. I can't normalize having a trading strategy that produce 10 consecutive losses in a row and thinks that everything is okay, right? I just can't. And this is what gets really, really interesting, right? I want you to have a look at this, right? So from 10 consecutive losses to 11 consecutive losses, even though it's dropped pretty significantly from 69, so 70%, 69.1% to 55%. But have a look, 55%. What did I say about mathematical probability? So anything above 51% is more likely to happen than not. So even if it has dropped significantly, 11 consecutive losses in a row is still more likely to happen than not, right? 55%. Now with this one, trading strategy with 60% win rate, from 4 consecutive losses to the next one up, 5 consecutive losses. Not only that, it actually has dropped significantly from 70% to 37%. Have a look, it's 37%. That means is anything less than 51% is less likely to happen, right? So not only that it dropped significantly, you really have a good chance of that not happening, right? Because it's less than 51%, yeah? And to the next one, right, even lower, right? Look at this, it's only 17% chance of 6 losses in a row. Yeah, so I seriously believe that if you are new or developing or unprofitable trader, I think you should, build your trading strategy or starting from a higher win rate trading strategy instead of a high risk to reward and lower win rate. So these are some of the common approach to high risk to reward strategy, right? And this is, I believe these are the things that actually contributed to low win rate. Okay, so method number 1 is they use overly tight stop loss. Okay, so this is when I said about the right analysis. So you could have the right direction, you could have the right trade idea, you could have the right everything, but because of your stop loss is too tight, right? Yeah, it may still result in a loss. Okay. Method number 2 is overextending TP, take profit. Okay. It forces trader to take profit beyond logical move, and it tends to take back profit as well. If you were to adopt this kind of strategy, high risk to reward and low win rate, you need to get used to seeing your position in profit, but then price reverse on you and take you out on break even or on your stop loss. Okay, and by the way, just to clarify, generally, those traders that use method number 2, yeah, overextending take profit, so they actually extending their take profit further to achieve the higher risk to reward. Normally, their stop loss is not very tight, right? That's why they want to extend their take profit to be much longer. Those that actually use method number 1, right, overly tight stop loss, normally they don't need to extend the take profit too far, because I'll give you an example. If you use like a stop loss of 3 pips or 3 points, you know, you don't need price to travel like 50, 60, 100 pips, right, away from your entry, right, to achieve a high risk to reward ratio. Okay, but if you want to leave buffer for your stop loss, for price to move around, to achieve the high risk to reward, you will then tend to overextend your take profit much further away from your entry point, and sometimes it could take up like, you know, 1 full day or 2 days worth of daily range, which is very far. Method 3, the extreme high precision entry, meaning that there's just too many valid entries with very little to no room for error. Most of the times when you wanna, this actually especially true for those traders that actually use method number 1, because they want to tighten their stop loss, their entry has to be very precise as well. Right, so sometimes you have the right direction and the right trade idea, but your orders just did not get picked up because you have to go down to a much lower time frame. In that lower time frame, more often than not, you have more than one valid entry. You have like several, and you have to choose, you know, this entry, and then price just kind of left without you. The takeaway point from this video is this: remember, slot machine offers a huge risk to reward but very low win rate. The huge upside is not an edge, but a compensation to entice players to continue taking lower probability odds. The huge upside is not an edge, but a compensation to entice players to continue taking lower probability odds. So don't trade a slot machine, because you don't need to be a mathematician to figure out that you can't be consistent playing slot machine, right? So as a new or developing or unprofitable trader, starting with a high risk to reward but low win rate trading strategy will only impede your learning curve. Thank you for watching, guys. If you find this video useful, hit the subscribe button and don't forget to like, comment, and share. Make sure you check out my other videos too.